Greetings, everyone. Welcome to Liberty Call. It is the weekly wrap-up for Friday, January 6th, 2022. Hope everybody's having a fantastic week out there. Apologize, I'm a little stuffy today. My allergies are kicking my butt. Woke up and couldn't breathe out of my left side. And took some Sudafed a little while ago, so if I seem a little loopy, that's probably why. So anyways, much better day in the markets. See a lot of green, up 2% here domestically, and a lot of green across the globe. So looks like we'll end the week on a positive note. Again, the Fed came out in their Fed minutes and basically said, "Whoa, slow down, folks." I have an article I'm going to talk about there. The White House seems to think we're going to have a soft landing with this recession or whatever the hell we're in right now. I don't know. You can take that advice for what it's worth. And we'll go through all the economic data that came out this week and the markets. So if it's your first time watching, please give me some big old thumbs up, likes, shares, and subscribes. I'd greatly appreciate it. And let's jump in and take a look at the indexes for the week, or for today. The Dow Jones was up 2.12%, closed at 33,629. S&P 500 was up 2.25%, closed at 38.93. NASDAQ up 2.56%. Closed at 10,569. Small caps were up 2.37. The VIX fell 6.01% today. It's currently holding at 2111. Canada was up 1.58. Brazil was up 1.2. Mexico up 1.8. Jumping across the Atlantic, Germany was up 1.2. UK up 0.87. France up 1.47. Same with the Euro stocks. Netherlands was up 1.39, Spain up 1.09, Italy up 1.4, Switzerland up 0.79, and Portugal up 0.48. Russian indexes were split. The MOEX basically flat at down 0.01, RTSI up 0.2. And the overnight in Asia, the Japan was up 0.59, Australia up 0.65, New Zealand down 0.37. In China, the Shanghai was pretty much flat at up 0.08. The SESE component up 0.32. China A50 up 0.34. DJ Shanghai up 0.22. And the Hang Seng down 0.29. Taiwan weighted came in up 0.51%. So, like I said, pretty good day for January 6th across most of the markets. And I think a lot of people will take that. So, all right, well, let's go ahead and take a look and see how the week fared, even though it was a short week, with the second being a holiday for banks and the markets. The S&P 500 finishes the week off up 1.08. The Dow Jones finishes the week off up 1.42. NASDAQ is going to finish the week up barely 0.05. The Dow Transports were up about 3.38. And the Dow Utilities are finishing the week off up about 1.25. So all in all, not too terrible. But again, let's take a bigger look at where things are right now. This line starts at the beginning of last year in January of 2022. We can see the downward trend. Every time we come up to this resistance point, we seem to, bounce off of it, which we've done here in the last month, and have continued this downward trend until this really breaks. And let's go to the 2-day chart, and the momentum indicator goes back into positive territory. I really don't think that we're going to jump or really see any positive growth. I would, if I were to guesstimate this, I would say, your typical downturn takes about 18 months, which would put us sometime, mid-year before we really see the market capitulate and start to turn around. But again, it could be sooner, it could be later. There's a lot of other factors in there. But typically, I would expect to see some downward acceleration before that actually occurs. So we've kind of been in this slow lulling trend. Kind of reminds me a lot of 2007 and 8, where most of 2000, or the back half of 2007, and then most of 2008, it was just this slow, steady drip. It really didn't become real volatile until the end of the year when Lehman went out of business, and those things started to accelerate through guess it was March 9th was the bottom of the market in 2009. So we shall see what happens. But again, I'm not too worried about it. I think things will be fine in the long run. But, it's just going to be a little painful in the short run. So, all right, well, let's look at the economic data that came out this week. Initial jobless claims came in at 204,000. The forecast was 225. Last week's number was 223. So a little bit of an improvement there. Continuing jobless claims came in at 1.694 million. The forecast was 1.708 million. Last week's number was 1.718. So we dropped about 20-ish, 25,000 on that number over the last week. The U.S. PMI manufacturing index came in at a 46.2. Forecast was the same. Last month's number was a 47.7. And anytime the number is below 50, that tells us that that sector is contracting. So again, not to really be surprised. The job openings and labor turnover survey, or the JOLTs report, came in at 10.458 million jobs that were open. The forecast was 10 million on the nose. Last month's number was 10.512. So we did creep down a little bit on that number, but there still are a ton of jobs out there. What I would surmise is that probably just a lot of people don't have the skills to fill those jobs, or they don't want to do the work for the pay that's being offered. So the ADP Nonfarm employment change, we had a growth of 235,000 jobs. Forecast was 150,000. Last month's number was 182. The Services Purchasing Managers Index came out yesterday. Number was a 44.7. The forecast was 44.4. Last month's number was a 46.2. So we dropped about 1.5 points on that. So, but again, we've been in this steady downtrend for quite a while, going back into 2021. Unemployment rate came in at 3.5%. The forecast was 3.7. Last month's number was a 3.6. So the unemployment improved, but if you look at the U6 number, it's up over 6%. And if you go to there's some websites, I think it's called Shadow Stats. You can see what people who are involved in the financial world really think, as far as, a lot of these stats are kind of cherry picked and massaged to make them look better. But, at Shadow Stats, you can see what's really going on there. All righty. So that appears to be all the economic data this week. Let's go ahead and read through today's market recap. S&P 500 in rally mode as economic data eases fears of hawkish Fed. The S&P 500 jumped Friday as the December jobs report showing cooling wage growth and data pointing to a slight contraction in services activity eased fears about a more hawkish Federal Reserve. The economy created 223,000 jobs last month, well above economists' estimates of 200,000, but the unemployment rate fell to 3.5%. Hourly earnings fell more than expected to 4.6%, easing worries about wage growth, a spiral that would force the Fed to lean more hawkish on rate hikes. Again, I think they're still going to have to go above 6% or even as high as 7%. But, everyone keeps talking about, we could just stop raising rates now. It's no big deal. Treasury yields fell sharply as investors continue to price in step downs in the pace of rate hikes at the Fed's meeting next month. Sentiment was less hawkish. On a less hawkish Fed was also supported by data pointing to weakness in the economy following an unexpected contraction in services activity. The ISM non-manufacturing data for December fell to 40.6, missing expectations of a 55. A reading below 50 indicates contraction. We just talked about that a few minutes ago. But not everyone on Wall Street is convinced that the latest economic data will meaningfully shift the Fed's thinking on the pace of monetary policy tightening. Quote, the market seems to be thinking that given this trend of data, perhaps the Fed won't have to raise 50 basis points again in February. Maybe it'll be less, or maybe they'll choose to pause. We don't necessarily agree with that line of thinking, end quote. Brian Mulberry, chief portfolio manager at Zacks Investment Management, told Investing.com's Justine Ibrahim in an interview today. Quote, in the minutes from the Fed's December meeting released this week, it was unanimous among members of the FOMC group they are going to keep interest rates high all year long, end quote, Mulberry added. Materials and industrials led the broader market higher, while big tech also played a role buoyed by falling treasury yields. Apple rose more than 3% to lead the move higher in big tech, followed by Meta, Alphabet, and Microsoft. Tesla Inc., meanwhile, rebounded after hitting 101.82, a fresh 52-week low, as dip buyers emerged, even as demand worries intensified after the electric vehicle market cut prices on its EVs for the second time in 3 months. Quote, the price cuts that we're seeing in China is a demand story, but I do believe that at $100 a share, we're getting to a point where Tesla is starting to get to get a massive risk reward level on its own, despite going into Q4, where clearly they're going to lower guidance, end quote. Wedbush analyst Dan Ives said in a Bloomberg interview, quote, I think it's really the fear, end quote. In other news, Costco reported that sales increased $223.8 billion in December 2022, up 7% year on year, despite weaker economic backdrop weighing on consumers. McDonald's Corporation, I'm loving it, meanwhile, is reportedly eyeing job cuts as part of a reorganization plan to boost restaurant expansion, CNBC reported on Friday. All right, so some good news there. And if you remember yesterday, the article I talked about how, people were saying, well, we really should, start lowering interest rates, or else, kind of a veiled threat towards the Fed. Well, the Fed already had a retort from their Fed minutes. So let's dive into that. This is titled, The Fed Delivered a Message to the Stock Market. Big rallies will prolong the pain. And, yesterday's article basically said, well, if we, don't get our way, we're going to throw a big hissy fit. And, here's basically a response to that. It was a don't make me come back there moment from the Federal Reserve. A line from the minutes of the central bank's December policy meeting released Wednesday afternoon was taken by analysts and economists as a warning to financial market participants that the bets on a policy pivot in 2023 aren't welcome. And to the extent that equity rallies and other financial market developments loosen over financial conditions, those wagers will only force the Fed's policy setting FOMC to prolong the pain necessary to bring down inflation. Let me pause a moment so I can blow my nose. All right, here, let's jump back in. Here's the line. Quote, participants noted that because monetary policy worked importantly through financial markets and unwarranted easing in financial conditions, especially if driven by a misperception by the public of the committee's reaction function, would complicate the committee's effort to restore price stability, end quote. So in plain English, translated from Fed speak, the FOMC members do not like stock market rallies since they fear it could result in potentially inflationary consumer spending, end quote, said Louis Navarre, president and founder of Navarre and Associates, in a Thursday note. And what can be said about that? Quote, said differently, if equities continue to rally on bad economic news, the Fed will need to push forward to an even higher terminal rate, or, peak interest rates, and unofficially add weaker stocks to the mandate, wrote Ian Lingjin and Benjamin Jeffrey, rate strategists at BMO Capital Markets on Wednesday. So, like I said, basically the Fed's saying, don't get your, don't count your chickens before they hatch and start planning on the market rallying really, really fast, because, we may have to do this all year and we're already planning on it. So again, don't get ahead of yourself. If you're, someone out there who's promising, that the markets are going to return to normalcy, sooner than later, you're probably going to be very, very disappointed. So that was basically the response, or the retort, that how I take it. All right, last article here. Our government says that we're going to have a soft landing on this economic downturn. U.S. likely headed for economic, quote, soft landing, White House's Boushey says. The U.S. economy appears headed for a soft landing, with recent economic data pointing to an ongoing recovery, not a recession, White House economist Heather Boushey told Reuters on Friday. Boushey welcomed Friday's data after showing the U.S. economy adding jobs at a solid clip in December, with unemployment rate dropping to a pre-pandemic low of 3.5%, and said the biggest challenge facing the economy now was the ongoing tightness in the labor supply. Asked whether the United States could avoid recession, Boushey said, quote, "There are no indications that is where we are now," end quote. The steps have been taken, and the quote continues, "The steps have been taken, and it looks like we are in a very good position to have a soft landing that everyone is talking about," end quote, she said. The soft landing is the ideal Federal Reserve policy goal about raising interest rates and a situation in which inflation slows, but there are not enough job losses to trigger a recession. Other challenges, including the impact of war on Ukraine on energy prices and ongoing COVID risks, especially with China's shifting away from zero COVID policy, Boushey said. Boushey said she worries that the challenges finding affordable care for children, the elderly, and the disabled were still keeping men and women out of the labor force. Yeah, because that's why people don't work. The Biden administration had hoped to enact reforms to fund universal preschool and ensure improvements, but failed to win sufficient support in Congress. Yet, I don't see anywhere in the Constitution that paying for universal preschool is part of the job description of the federal government. But people seem to think the federal government can do everything. It's only supposed to do protection of the borders, ensuring a free trade zone between the states, and diplomacy with foreign nations. Outside of that, all this other crap that they do is unconstitutional. I'd like to see it all burned to the ground. Let's continue. The data that keeps coming out month after month shows that we continue to move forward. The evidence is not consistent with what a recession typically looks like, end quote. She said the signs all point to ongoing recovery and robustness in the labor market, end quote. So who is Heather Boushey? Well, let's look her up. She has a Wikipedia page. She's 52 years old, or going to be 52 years old. And let's see here. She was from the state of Washington, has a bachelor's degree from Hampshire College, and a PhD in economics from the New School of Social Research. That sounds important. What has she actually done that would give her any credibility? Well, she worked for basically big government and Washington companies, the Center for American Progress, the United States Congress Joint Economic Committee, the Center for Economic and Policy Research, and the Economic Policy Institute. So basically, this is a big government hack who's never had a real job. I don't see anything about JP Morgan Chase, Bear Stearns, any of the big financial players. So this is basically a person who's had a government job her whole life, or worked kind of in the periphery of government jobs. So again, I don't know if I take her advice with much of a grain of salt, simply because everything the government has said over the last 2 to 3 years has been BS. And they try to, placate the masses with, this inflation is just transitory. It's nothing to worry about. But anyways, it's not because she's part of the Biden administration. I have very little trust in either side of the aisle. I think they're all thieves. But anyways, all right. Well, that's everything I had for today. So hopefully I didn't give you too much grim news that while the White House is saying everything's fine, I personally don't think so. I think things are going to get pretty rough. For people who are nimble and, can adapt to the environment, I think they're going to be okay. But I think there's going to be some folks out there in the labor market who are not going to be real happy about getting laid off, or their companies going belly up because of, future economic conditions that I personally imagine are going to get worse, not better for the time being. So, all right. Well, like I said, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. Hope everyone has a fantastical weekend, and I'll talk to you next time. Adios.